What if there was a way to pay off your house years faster and add hundreds of thousands of dollars to your future net worth? All of this with no cash out of pocket. This is rental cash damming. Like most Canadians, you probably have a very large monthly mortgage payment and you're decades away from being able to pay it off. I want to show you a strategy that is more relevant than ever given high interest rates and the rising cost of home ownership that seems to continually outpace our monthly paychecks. I want to show you how to structure your mortgage in a way that helps you be more tax efficient so that you can grow your real estate portfolio and keep more of your hard-earned money along the way. I'm then going to show you how to use those tax savings, your tax refunds, to reduce your mortgage balance, pay less interest, and become mortgage-free years ahead of schedule. The amazing part about the strategy is it doesn't require additional cash. You're simply reorganizing cash flows and payments that you might already have. We'll structure it in a way that's more tax efficient, and the benefits come in the form of tax refunds and interest savings when you use those refunds to pay your mortgage off faster. This helps you reduce long-term interest costs and shortens the time it takes to pay it off, and you can relax being mortgage-free. So what is this mythical strategy? It's called cash damming. It is the technical term attributed to the strategy by the Canada Revenue Agency. It's the process of segregating non-deductible and deductible cash flows so that you can accurately and safely claim the tax deductions on your mortgage debt. Who is this strategy for? It's for Canadians who have a principal residence with approximately 15 years left to pay it off, and especially homeowners who already have rental income properties or basement suited homes. You see, lots of Canadians don't actually realize how much interest they pay over the lifetime of their loan. In most cases, it's almost as much of the cost of the home because of the interest paid over time. If we took a $600,000 loan amortized over 30 years at an interest rate of 4.54%, a borrower would pay $494,000 of interest to the lender, only $105,000 short of the original purchase. But what can be done about that? Nothing. We can't just pay cash for the home. We don't have the resources. We need borrowed funds from lenders just to buy the home in the first place. And because the government doesn't view our principal residence as an investment, we can't write off the interest unless we get creative. This is where the rental cash damming strategy comes into play. It allows us to structure our finances to take advantage of these benefits gradually over time with the right mortgage structure, where we can incrementally access your equity to build wealth, buy more real estate, reduce the taxes you pay, and improve your cash flow so that you can get more of your hard-earned tax dollars back, reinvest the savings, and the beauty of it is you can accomplish all of this simply by making your regular mortgage payment, with the ultimate goal of converting your non-deductible debt as fast as you can and convert it into a tax-deductible investment loan so that you can claim your maximum eligible tax refunds against the debt. The reason this works is because the federal government has a rule that states if you borrow money to invest, the interest on the borrowed funds are tax deductible. Because you borrowed with the intent of generating an income, you can deduct the carrying costs of the loan. Keeping in mind when buying real estate that it must be a rental. It can't be for personal use. This doesn't work for second homes and vacation properties that you don't rent out, but it definitely works when you generate income from the property. Now that we have an understanding of why we should rental cash dam, let's dive in further and look at some numbers to give you a sense of how powerful this can be and the kind of financial benefits a typical homeowner might expect over the life of their mortgage. Let's consider a typical scenario for a homeowner with a $500,000 mortgage and a primary residence valued at $800,000. The first point to note is this only works when you have at least 20% equity in your home. The reason for this is the multi-component structures that we need to run the strategy are only available up to 80% of the value of the home. You do need to have a bit of equity to get started. Since the home is worth $800,000, the homeowner is technically able to set up a structure with a credit limit of $640,000. That's 80% of the $800,000. They owe the $500,000 on their mortgage, which leaves another $140,000 that can be accessed and used as a down payment to purchase a rental property. This gives the borrower the ability to purchase a rental property where worth approximately $500,000. They use $125,000 of the down payment, plus they have a small buffer left around for closing costs. Keep in mind, you don't need to purchase a rental property if you already own one. You can just reorganize the cash flows from your existing portfolio and put this strategy to work right away without buying additional properties. So we're acquiring an income generating asset that will help us build additional wealth for the future. We are going to structure our principal residence so that we can use the cash flows from the rental to convert our home mortgage into a tax-deductible investment loan. This is going to allow us to reduce our taxes and keep more of our hard-earned money. And we're going to accomplish all of this without any additional cash inputs beyond our regular mortgage payment. Let's now go over how to structure our mortgage, and we'll dive into some numbers for you. For this strategy to work, we need to use a readvanceable home equity line of credit on the principal residence. There are lots of mortgage products out there that might look like they work for the strategy. However, many of the products actually lack some of the features required to run the monthly cash flow cycle. It's important that the home equity line of credit is set up for auto readvance, which means that the principal that gets paid down on the non-deductible mortgage automatically becomes available to draw from the line of credit. It is important that the home equity line of credit is set up for auto readvance, which means that the principal that gets paid down on the non-deductible mortgage automatically becomes available to draw from the line of credit, so that funds are available to be drawn out in a timely manner. If the structure doesn't have that readvanceable feature, it's going to cause friction and there will be implementation issues. Now, the ultimate goal here is to pay down your non-deductible debt as fast as humanly possible, and the way we do that is by applying the rental income as a prepayment on the mortgage each month. Then we borrow that same amount from the HELOC to service the rental property expense. Each month, we convert more and more of your mortgage over to the investment line, which results in increased tax refunds that you can use to pay down your mortgage even faster and accelerate your wealth building efforts. So here's how it works. We make our regular mortgage payment each month to the principal residence mortgage. Our payments are set to come from our household bank account, same as before, nothing changes. Then we have the rental property. The first thing that happens in the cash flow cycle each month is the tenant pays the rent. On the first of the month, we get a payment. Now, what most Canadians will do is deposit the income in the bank and then pay the expenses on the property from that same account, which is totally fair because we've all been taught to do it that way. But when we do it this way, we miss a wonderful opportunity to create additional tax efficiencies for ourselves, because there's actually no rule that says we need to use the rental income to pay our rental expenses. When we receive the income from the tenant, it's ours. We can do whatever we want with it. What we're going to do is use the rental income to pay off our non-deductible debt first. Because we don't get any tax benefits for carrying that mortgage, it's a bad debt, so let's get rid of it. We also make our regular mortgage payment, same as before, and we make an additional prepayment equal to the value of the monthly rent. The principal portion of our regular mortgage payment and the full value of the prepayment goes directly to pay down our mortgage balance, and the equity becomes available in the investment line of credit. We then draw back out to cover the rental expenses and run our landlord business. That's it. Every single month, we use the rental income to prepay our mortgage, and we borrow the funds to cover the rental expenses. So in our scenario, the homeowner has a $500,000 mortgage on their principal residence. They use the mortgage to buy the home, so they're not currently getting any tax benefits on the debt. They're on a 30-year amortization at 4.49%, which means their monthly mortgage payment is $2,518. Their marginal tax bracket is 36%, which means that for any debt they convert to a tax-deductible investment loan, they'll end up getting 36% of the interest back every year at tax time. The rental property is worth $500,000. It has a mortgage on it with a balance of $400,000. And the total annual cost to run the property is just over $35,000 annually. The expenses include $2,108 for monthly mortgage payments, principal and interest, $150 for maintenance, $110 for insurance, $200 for management, and $375 for property taxes. Using this rental, let's see the huge upside potential for this client. We've got the principal residence, which we make our regular $2,518 monthly payment. The payment comes from the homeowner's regular household bank account. We receive $48,000 in rental income annually on the property. That's $4,000 each month that we can use to prepay the mortgage and get rid of the homeowner's non-deductible debt. That equity becomes available in the investment line of credit, and we draw the $3,500 of rental expenses into the rental checking account. From there, we use the funds to make all the payments on the rental property. That's the cycle every single month. We get our rental income and run it through the primary residence mortgage, convert bad debt over to the tax-deductible side of the balance sheet, and draw the funds out to pay our rental expenses. Here are the financial benefits of this particular client. The first thing we look at is how long it takes to move the full balance of the mortgage over to the investment line. We call this debt conversion, and depending on how many properties there are, it can typically take anywhere from 6 to 12 years to complete this first phase. In this case, debt conversion is achieved in year 7. This doesn't mean that the mortgage is paid off. It just means that we've reached the point where the debt is completely tax deductible and we're receiving our maximum annual tax refunds. The next thing we look at is the total value of the refunds earned in the plan. This assumes that the rate of interest is constant and the marginal tax rate doesn't change either. In reality, these things can fluctuate, but this gives us a sense of the total amount of tax refunds we can expect to achieve using this strategy. In this case, the homeowner receives just under $93,000 in refunds over the life of the mortgage. Technically, the homeowner can do whatever they want with the refunds. They can save the money or spend it, but when we do projections, we assume the homeowner will use the refunds to pay down the mortgage faster. In this example, the net effect of using the tax refunds to accelerate the plan is they're able to pay off their mortgage 143 months ahead of schedule. In this example, the net effect of using the tax refunds to accelerate the plan is they're able to pay off their mortgage 143 months, almost 12 years ahead of schedule, which saves over $360,000 in future mortgage payments. Technically, the homeowner is mortgage-free at the 18.08 year mark, but in order to provide an apples-to-apples comparison, we assume they continue making payments and reinvest those 143 payments to the end of their original amortization so they can earn a rate of return on future savings. The calculator allows us to play with different growth rate assumptions, and for this scenario, we are using 6%, which results in a future value of the invested payment savings is just over $524,000. We also calculate the future value of the rental, which is $906,843. This gives the borrower an estimated net wealth benefit of $1.4 million. And keep in mind, in this example, there are no outstanding liabilities in the investment line of credit, and the rental mortgage are both paid in full. We can also quickly check the benefit for a client who already has a rental property. In this case, we would deduct the $125,000 from the line of credit and not factor in the future value of the rental property. Their mortgage debt would be converted in 7.33 years. They would receive $43,339 in refunds. They would pay their mortgage off in 14.42 years rather than 30, reducing their payments by 187. Reducing 187 payments. This saves them from making $470,000 in payments, which invested at 6% increases their net worth by $776,000. This is a taste of what rental cash damming can do for you and your family, and I hope this has gotten you excited about how a strategy like this can absolutely change the way you look at mortgages and investment. If after watching this video you have a scenario you would like to run by me, please feel free to use the calendar link in the description of this video. The initial call is completely free with no obligation to move forward. I'll walk you through your rental cash damming scenario and the type of benefits you can expect. If you love this video, subscribe for more content that will change your financial future.